If you believe, as I do, that the deterioration of the purchasing power of the US dollar is more like 7.5 than it is to 2.5, then the fact that you're getting paid 4% on your 10-year treasury, on your deposit products, in a currency that's depreciating by 7.5% means that the money that you're saving is losing you 3.5% a year in purchasing power. There is nothing in the world that would cause me as much concern about the deterioration of my purchasing power as that simple piece of math. I would suggest that the beneficiary of this, once that arithmetic comes to be felt in the market, will be first in the gold market.
Since early 2024, the price of gold has been climbing, and the uptick has been nothing short of remarkable, with gold shattering multiple price records so far this year. Over the last 20 years, annual inflation has averaged 3% in the UK, according to the Office for National Statistics. Over the same period, the price of gold has increased by an average of 9% per year, according to the World Gold Council. In 1971, facing a growing deficit in U.S. gold reserves compared to outstanding U.S. dollars, President Nixon suspended the convertibility of dollars to gold. Consequently, the U.S. dollar entered a bear market from February 19, 73 to July 19, 73, declining roughly 15%. Gold rose around 75% over the same period. In his analysis, RickRule, founder and CEO of Rule Investment Media, questions the rationale behind the recent 50 basis point rate cut if the economy is robust. Highlighting the disconnect between perception and reality, Rick argues that gold benefits when faith in fiat currencies diminishes. He suggests that true inflation may be closer to 7.5%, meaning a 4% yield on a 10-year treasury bond erodes purchasing power. According to the CPI, since the inception of the Federal Reserve in 1913, the dollar has lost no less than 97% of its purchasing power. On the other hand, gold preserved its value during the same period, and according to the CPI, even gained purchasing power. Adjusted for inflation, the price of an ounce of gold in 1913 is equivalent to 662 present-day dollars, whereas the current price is about 2,500 US dollars. In a reflective moment, Rick discusses how the dollar's purchasing power plummeted from 1970 to 1981, pushing gold prices from $35 to over $800. He predicts a shift from the recent economic boom to caution, driving further dollar depreciation and increased interest in gold. Now we present the clips of RickRule's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Gold, in my experience, has done particularly well when people are concerned about the maintenance of purchasing power in their domestic currency. This Fed decision is really interesting. We're told we have a great economy, and the equities market would suggest we have a great economy. If we have a great economy, why do we need a 50 basis point rate cut? That's of interest to me. A broader topic, I think, Michael, around gold is the fact that if you believe, as I do, that the gold price does well when people are concerned about the maintenance of purchasing power in fiat-denominated instruments, let's do a little bit of arithmetic. The government would have you believe that inflation, their measure of the deterioration of the purchasing power of the US dollar, according to the CPI, is cruising along at 2.6. If you believe that, earning 4.2, 4.3, or now 4 in the US 10-year treasury isn't a bad deal. You get paid 4% real yield in a currency depreciating by 2.6% a year. You get a positive real yield. I don't believe those numbers, Michael. I do a thought exercise every year, and I have for 6 years, around the pricing of the basket of goods and services that I consume in my life. The government, when it's inconvenient, doesn't include food or fuel. Unlike you, Michael, I'm not on a fast. So the price of food is of some import to me. Importantly, the government number in the CPI doesn't include the cost of government itself. While tax is usually the largest component of every household budget, every working family in the United States. If you believe, as I do, that the deterioration of the purchasing power of the US dollar is more like 7.5 than it is to 2.5, then the fact that you're getting paid 4% on your 10-year treasury, on your deposit products, in a currency that's depreciating by 7.5% means that the money that you're saving is losing you 3.5% a year in purchasing power. There is nothing in the world that would cause me as much concern about the deterioration of my purchasing power as that simple piece of math. Period 1970 to 1981 is that we reduced the purchasing power of the dollar through inflation by over 80% in 11 short years. The consequence of that is that the gold price, of course, went from a price controlled $35 an ounce, pardon me, to a price in excess of $800 per ounce. What's germane to the question is that the writing was on the wall around inflation beginning in 1968, but it didn't become a matter of popular concern until 1972 or 1973. If you dial back to that circumstance, if you dial back to those days, we had experienced very, very, very buoyant economic conditions from the end of World War II, say 1946, all the way through 1968. The Nifty 50 is an example, the wonderful growth of American hegemony around the world, the strength of the US dollar, and people were conditioned to be optimistic. I would suggest that we have lived through an even longer and even more beneficent circumstance from 1982 to 2022. Wonderful boom wonderful strength in the US dollar, wonderful equity markets, wonderful bond markets, a lot of animal spirits, people being trained to buy the dip, people not being afraid. I personally believe that this beneficent epoch that we enjoyed, this 4-decade epoch, came to an end in 2022. And I personally believe that there will be a lag in psychology from a psychology of boom to a psychology of caution. By the way, I'm not calling for the Greater Depression. I'm not calling for the end of the US dollar. I'm not doing all that doom and gloom stuff. All I'm saying is that there is going to be a reckoning as a consequence of the obligation that our society favors. And that reckoning, I think, almost necessarily results in the continued and accelerated depreciation of the purchasing power of the US dollar, and increasingly, too, a recognition of the benefits of gold.
During the interview, RickRule expressed strong confidence in silver stocks, noting they tend to outperform in the later phases of a gold bull market. He points out that recent trends have led to significant gains in this sector, causing his allocation to rise from 2.5% to around 3.5% of his portfolio. In a commodities-based research report released over the weekend, major broker Citi has issued substantially bullish commentary on silver. The timing could not be better, considering silver prices have just begun to move again after stagnating since a June peak. Since that peak, silver has notably lagged behind gold, as that precious metal has made a string of record highs. Hecla Mining is trading at a new 52-week high, but Wall Street analysts think there is much more room to keep moving higher. The forecast is now set at 125% earnings per share (EPS) growth for the next 12 months, which should be enough to bring the stock to a new all-time high. Let's get back to the interview.
I am not buying silver bullion. I have a fairly large position in gold bullion. By the way, I'm stupid to do that. I'm the largest shareholder of Sprott Inc. And if the gold market and the silver market run, in theory, the most important brand name for retail investors in gold in North America is Sprott, I will do well. But I own gold bullion because it helps me sleep nights. And at age 71, that's a real benefit. I do own silver stocks. And I own silver stocks because towards the middle of a gold bull market, through the end of the gold bull market, historically, there is no asset class that performs as well to the upside as the silver stocks. The population of legitimate silver stocks is very small, and their combined market capitalizations are very small. 4 times before in my career, the precious metals narrative has been such that the generalist investors go first into the gold equities, but later into the silver equities. And the combined market capitalizations of the silver equities, we'll call that the silver silo, is so small that it can't handle the influx of capital that comes in. And the results can be very dramatic, Michael. I remember in the decade of the 70s, when I was too young and too dumb to play well, Coeur d'Alene Mines went from 10 cents a share to $65. In the latter part of the decade of the 80s, before that wonderful bull market that happened 91 to 96, I was able to finance two small silver companies. One, Pan American Silver at 50 cents, the other, Silver Standard at 72 cents. 6 or 7 years later, both of those stocks had crested through $40. So when I say that in a silver bull market, the asset class that performs most dramatically to the upside is silver stocks, that is an indication. I was vocally bullish about silver stocks in December of last year and January of this year, for the simple reason that there was so much hate concerning them on social media. I determined that from my own viewpoint, almost everybody who wanted to sell had sold because there was no love, there was only hate. The consequence of that subset of silver stocks has done very, very well, up about 50, 60% in the first, 7, 8 months of 2024. In direct answer to the question, about 2.5% of my total portfolio was invested in silver equities. That has become about 3.4, 3.5% of my portfolio, not because I've added more money to it, but simply because the prices of the small silver stocks has outperformed most other asset classes in the ensuing period.
In a report published last week, commodity analysts at Capital Economics said they were in the process of upgrading their silver price forecast. Still, they warned it won't match their bullish outlook on gold. How do you perceive the role of precious metals in your investment strategy? And do you think silver could catch up to gold in the coming months? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.